Welcome to this book summary video of The Intelligent Investor by Benjamin Graham. This classic book, first published in 1949, is considered the Bible of value investing and has influenced generations of investors, including Warren Buffett. In this video, we'll break down every chapter of the book so you can get a comprehensive overview of its key concepts and insights. And if you want to dive deeper into the world of value investing, you can follow the link in the description to get your own copy of The Intelligent Investor. Chapter 1: Investment versus Speculation. Investing involves analyzing the financial performance of a company, its management, and its competitive position in the industry. The goal is to identify stocks that are undervalued by the market and have the potential for long-term growth. Graham emphasizes the importance of diversification, warning against putting all of one's eggs in a single basket. He also stresses the need for patience, as the market can be unpredictable in the short term, but tends to reflect the underlying value of companies over the long term. In contrast, speculation involves trying to time the market or make short-term trades based on rumors or trends. Graham argues that this approach is inherently risky and unlikely to produce consistent returns over time. He warns that speculators often fall victim to their own emotions, buying and selling based on fear or greed rather than rational analysis. Ultimately, Graham believes that the intelligent investor should approach the stock market with a sense of detachment and discipline, focusing on long-term value rather than short-term gains. Chapter 2: The Investor and Inflation. Graham explains that inflation is a fact of life, and it can have a significant impact on the value of investments. As prices rise, the purchasing power of money decreases, and investors may find that their returns are not sufficient to keep up with the cost of living. He notes that this problem is particularly acute for fixed-income investments like bonds, which offer a fixed rate of return that may not keep pace with inflation. To combat this problem, Graham recommends that investors consider a range of assets that can provide protection against inflation. These might include stocks, real estate, and commodities, which tend to appreciate in value over time and can provide a hedge against rising prices. He also suggests that investors consider buying inflation-protected securities like Treasury inflation-protected securities, TIPS, which offer a guaranteed rate of return that is adjusted for inflation. Chapter 3: A Century of Stock Market History. In this chapter, Graham takes a deep dive into the history of the stock market and examines its performance over the course of a century. He notes that while the market has experienced many ups and downs, it has generally exhibited long-term growth, with the average annual return for stocks far outpacing that of bonds and other fixed-income investments. Graham also cautions against trying to time the market or follow the latest market forecasts. He argues that such approaches are inherently risky and unlikely to produce consistent returns over time. Instead, he advises investors to adopt a long-term perspective, focusing on the underlying value of companies and their ability to generate profits over the long term. To illustrate his point, Graham provides a number of historical examples of investors who were able to achieve significant returns by holding onto their investments through periods of market volatility. He notes that while it can be tempting to try to make quick profits by buying and selling stocks based on short-term market trends, such approaches are unlikely to produce consistent results over the long term. Chapter 4: General Portfolio Policy, the Defensive Investor. Chapter 4 of The Intelligent Investor focuses on the general portfolio policy for the defensive investor. Graham introduces the concept of a defensive investor, who is an individual that is primarily concerned with minimizing the risk of loss and achieving a reasonable return. He notes that defensive investors may lack the knowledge or expertise to invest in riskier assets or actively manage their portfolios, and therefore, they should adopt a more conservative approach to investing. Graham recommends that the defensive investors should focus on buying high-quality stocks and bonds, which he defines as those issued by companies with a long track record of profitability, stable earnings, and a strong financial position. He suggests that the defensive investors should diversify their portfolio across different asset classes, including stocks, bonds, and cash, in order to reduce the risk of loss due to market fluctuations. Graham also suggests that the defensive investor should aim to achieve a reasonable return on their investments, but should not be overly concerned with trying to beat the market. He notes that attempting to outperform the market can lead to excessive risk-taking and may result in lower returns over the long term. Chapter 5: The Defensive Investor and Common Stocks. In Chapter 5 of The Intelligent Investor, Graham focuses on how the defensive investor should approach investing in common stocks. He notes that while stocks can provide a higher return than bonds or cash over the long term, they also come with a higher level of risk. Therefore, the defensive investor should be careful when selecting stocks and should look for companies with a strong financial position, stable earnings, and a solid dividend record. Graham provides guidelines for selecting stocks, including looking for companies with a long track record of profitability and growth, a history of paying dividends, and a low debt-to-equity ratio. He also recommends that the defensive investor should avoid stocks with high price-to-earnings ratios or those that are overly dependent on a single product or market. Graham also discusses the role of index funds and mutual funds in the defensive investor's portfolio. He notes that these funds can provide diversification and professional management, which can be particularly helpful for investors who lack the time or expertise to manage their own portfolios. However, he cautions that investors should be careful to select funds with low fees and a proven track record of performance. Chapter 6, Portfolio Policy for the Enterprising Investor, Negative Approach. Chapter 6 of The Intelligent Investor is aimed at the enterprising investor, who is willing to take more risk and seek higher returns than the defensive investor. Graham presents a negative approach to portfolio policy, which involves avoiding overpriced or risky stocks and focusing on bargains and special situations. Graham notes that the enterprising investor should be willing to do their own research and analysis and should be prepared to take a more active role in managing their portfolio. He suggests that the enterprising investor should avoid stocks that are overpriced or have a high level of risk, and instead focus on finding bargains or special situations that offer the potential for high returns. Graham provides guidelines for selecting stocks, including looking for companies that are undervalued by the market, have a strong financial position, and are likely to experience growth or positive changes in the future. He also suggests that the enterprising investor should be willing to invest in special situations, such as spin-offs or liquidations, that may offer unique opportunities for profit. Chapter 7, Portfolio Policy for the Enterprising Investor, The Positive Side. In Chapter 7 of The Intelligent Investor, Graham presents a positive approach to portfolio policy for the enterprising investor. This approach involves seeking out undervalued stocks and bonds, and using various techniques such as arbitrage, liquidation analysis, and earnings power value. Graham notes that the enterprising investor should be willing to do their own research and analysis, and should be prepared to take a more active role in managing their portfolio. He suggests that the enterprising investor should be willing to invest in companies that are undervalued by the market and have the potential for growth or positive changes in the future. Graham provides guidelines for selecting stocks, including using various techniques such as arbitrage, liquidation analysis, and earnings power value. He also notes that the enterprising investor should be willing to take advantage of market timing and market psychology, which can provide opportunities for profit. Graham emphasizes the importance of maintaining a disciplined approach to investing and avoiding excessive risk-taking. He notes that even the most skilled and knowledgeable investors can make mistakes, and that it is important to maintain a diversified portfolio in order to reduce risk. Chapter 8, The Investor and Market Fluctuations. Chapter 8 of The Intelligent Investor focuses on the psychological and emotional challenges that investors face when the market fluctuates. Graham notes that many investors are prone to panic or greed when the market goes up or down, and that these emotions can lead to irrational decision-making and excessive risk-taking. Graham emphasizes the importance of maintaining a disciplined and rational approach to investing and avoiding the temptation to follow market trends or herd behavior. He notes that investors who are able to stay calm and focused during market fluctuations are more likely to achieve long-term success. Graham provides guidelines for investors who are struggling with market fluctuations, including maintaining a diversified portfolio, avoiding excessive risk-taking, and focusing on the underlying value of companies rather than short-term market trends. He also notes that investors should be patient and disciplined, and avoid making impulsive decisions based on fear or greed. Chapter 9, Investing in Investment Funds. Chapter 9 of The Intelligent Investor focuses on investing in investment funds, such as mutual funds, closed-end funds, and unit trusts. Graham discusses the pros and cons of investing in these funds and provides guidelines for selecting funds based on their expenses, management, and performance. Graham notes that one of the primary advantages of investing in funds is that they provide diversification, which can help to reduce risk. Additionally, funds are typically managed by professionals who have the knowledge and expertise to make informed investment decisions. However, Graham also warns against the pitfalls of excessive diversification and high fees. He notes that some funds may be overly diversified, which can lead to mediocre returns and high fees. He recommends that investors should focus on selecting funds that have a clear investment strategy and a proven track record of performance. Graham provides guidelines for selecting funds, including examining the fund's expenses, management, and performance. He notes that investors should be wary of funds with high fees, as these can eat into returns over the long term. Additionally, investors should be sure to examine the fund's management team and their track record of success. Chapter 10, The Investor and His Advisors. Chapter 10 of The Intelligent Investor focuses on the role of investment advisors and brokers, and how investors can select competent and trustworthy professionals to help them manage their portfolios. Graham emphasizes the importance of understanding the fees and costs involved and the need to avoid conflicts of interest. Graham notes that many investors rely on the advice of professionals to help them manage their portfolios, and that it is important to select advisors who are competent, trustworthy, and have the investor's best interests in mind. He warns against advisors who may have conflicts of interest or who may be motivated by commissions or other financial incentives. Graham provides guidelines for selecting advisors, including examining their experience, credentials, and track record of success. He also recommends that investors should be sure to understand the fees and costs involved, including any commissions, management fees, or other charges. Chapter 11, Security Analysis for the Lay Investor, General Approach. Chapter 11 of The Intelligent Investor introduces the principles of security analysis, which involves evaluating the financial and business prospects of a company to determine its intrinsic value. Graham provides guidelines for the lay investor to conduct a basic analysis of stocks, bonds, and other securities. Graham notes that security analysis is an essential tool for investors who are seeking to make informed investment decisions. He explains that security analysis involves examining the financial statements of a company, its management team, and its competitive position in the industry. The goal is to determine the underlying value of the company and its potential for long-term growth. Graham provides guidelines for the lay investor to conduct a basic analysis of stocks, bonds, and other securities. He notes that investors should be sure to examine the company's financial statements, including its balance sheet, income statement, and cash flow statement. Additionally, investors should examine the company's management team and their track record of success. Graham also notes that investors should be sure to consider the competitive position of the company in the industry, including its market share, product offerings, and potential for growth. Additionally, investors should consider the economic and market conditions that may impact the company's performance over the long term. Chapter 12, Things to Consider About Per Share Earnings. Per share earnings are a vital metric for investors to consider when evaluating the potential of a stock. In Chapter 12, Graham highlights the importance of understanding the different types of earnings, such as gross earnings, net earnings, and operating earnings, and how they can be affected by factors such as accounting practices and one-time events. By understanding these nuances, investors can make more informed decisions about the true value of a company and its potential for growth. In addition to examining earnings, Graham also explores the role of dividends and retained earnings in determining a company's value. Dividends represent a portion of a company's earnings that are distributed to shareholders, while retained earnings are reinvested back into the company. Graham argues that while dividends can be attractive to investors seeking regular income, retained earnings can be just as valuable in terms of funding future growth and increasing the overall value of the company. Ultimately, by considering per share earnings, dividends, and retained earnings, investors can gain a more comprehensive understanding of a company's financial health and potential for long-term success. Chapter 13, A Comparison of 4 Listed Companies. In Chapter 13, Graham provides a detailed comparison of 4 listed companies, highlighting the importance of quantitative analysis in evaluating their financial performance. He emphasizes the need to use multiple criteria to gain a comprehensive understanding of a company's strengths and weaknesses. By examining the company's financial statements, Graham demonstrates how investors can evaluate their profitability, liquidity, and solvency. Graham also discusses the importance of considering a company's management and competitive position when making investment decisions. He examines the company's management teams, their strategies for growth, and their market positions. By looking at both quantitative and qualitative factors, Graham shows how investors can make informed decisions about which companies are most likely to provide long-term value. Chapter 14, Stock Selection for the Defensive Investor. In Chapter 14, Graham provides a comprehensive guide for defensive investors to select stocks based on fundamental characteristics. He emphasizes the importance of investing in financially strong companies with a history of stable earnings and a consistent dividend record. Graham also highlights the significance of a stock's price-earnings ratio and how it can indicate whether a stock is overpriced or undervalued. Furthermore, Graham stresses the importance of diversification in a defensive investor's portfolio. He advises investors to spread their investments across multiple industries and companies to minimize the risk of losses. Graham also warns against investing in speculative or overpriced stocks, which can lead to significant losses and undermine the overall success of a portfolio. Chapter 15, Stock Selection for the Enterprising Investor. In Chapter 15, Graham provides an advanced approach to stock selection for the enterprising investor. He suggests seeking out undervalued or special situation stocks that offer high potential returns. Graham emphasizes the importance of conducting thorough research and analysis to identify stocks that are mispriced or overlooked by the market. To illustrate his approach, Graham provides examples of various techniques, such as net stocks, bargain issues, and liquidation values. Net stocks are companies whose current assets exceed their current liabilities and market capitalization, indicating that the stock is undervalued. Bargain issues are stocks that are trading at a significant discount to their intrinsic value, while liquidation values refer to the value of a company's assets if it were to be liquidated. Graham also discusses the importance of diversification for enterprising investors, as the approach involves taking on higher risk. He advises investors to spread their investments across multiple undervalued or special situation stocks to minimize the risk of losses. Chapter 16, Convertible Issues and Warrants. Chapter 16 focuses on the role of convertible issues and warrants in an investor's portfolio. Graham explains that convertible securities are bonds or preferred stocks that can be converted into common stock, while warrants are similar to options that give the holder the right to purchase stock at a predetermined price. Graham discusses the mechanics and risks involved in these types of securities and how they can be used to enhance returns or reduce risk. For example, convertible securities may provide a higher yield than traditional bonds, while also offering the potential for capital appreciation if the stock price rises. Warrants can also provide the opportunity for significant gains if the stock price increases, but can also result in losses if the stock price decreases. To select convertible issues and warrants, Graham advises investors to consider their terms and conditions, such as conversion price, conversion ratio, and expiration date. He also warns investors to be cautious of overpriced or complex securities and to conduct thorough research and analysis before making any investment decisions. Chapter 17, for extremely instructive case histories. In Chapter 17, Graham presents 4 case studies of companies that experienced significant changes in their financial and business prospects, and how investors could have analyzed and responded to these changes. He emphasizes the importance of staying alert and flexible, and avoiding emotional or irrational reactions. Graham discusses the case of American Can Company, which experienced a decline in its core business and shifted its focus to more profitable ventures. He illustrates how investors could have analyzed the company's financial statements and business prospects, and made informed decisions about whether to invest or divest. Graham also examines the case of Geico, which faced financial difficulties and was eventually acquired by Berkshire Hathaway. He illustrates how investors could have analyzed the company's financial statements and competitive position, and made informed decisions about whether to invest or divest. Furthermore, Graham discusses the case of Northern Pipeline, which faced regulatory challenges and ultimately became a successful investment opportunity for those who remained patient and flexible. He illustrates how investors could have analyzed the company's regulatory issues and financial statements, and made informed decisions about whether to hold or sell. Chapter 18, a comparison of 8 pairs of companies. Chapter 18 provides a comparative analysis of 8 pairs of companies, highlighting the importance of evaluating them based on their financial and business characteristics. Graham emphasizes the need for a systematic and objective approach to analysis and the importance of avoiding bias or preconceptions. Graham compares companies such as General Motors and Ford, Procter & Gamble and Colgate-Palmolive, and Sears and Montgomery Ward. He examines their financial statements, competitive positions, and management teams, and provides insights on how investors can make informed decisions about which companies to invest in. Graham also discusses the importance of considering a company's industry and market position when making investment decisions. He emphasizes the need to analyze a company's competitive advantages and potential for growth, and to avoid investing in companies that are facing significant challenges or declining markets. Chapter 19, Shareholders and Management's Dividend Policy. Chapter 19 focuses on the relationship between shareholders and management and the role of dividend policy in this relationship. Graham explains the different types of dividends, such as regular cash dividends, extra dividends, and stock dividends, and how they can reflect a company's financial strength and growth prospects. Graham emphasizes the importance of a company's dividend policy in attracting and retaining shareholders. He explains that companies with a consistent and increasing dividend history are often viewed as more favorable by investors as they demonstrate financial stability and growth potential. Furthermore, Graham discusses the role of stock buybacks and stock splits in a company's dividend policy. He explains that stock buybacks can be an effective way for companies to return capital to shareholders and increase the value of their shares. Stock splits, on the other hand, can make a company's shares more affordable for individual investors and increase liquidity. Chapter 20, Margin of Safety as the Central Concept of Investment. Chapter 20 serves as a summary of Graham's key concepts and insights throughout the book. Graham introduces the central concept of margin of safety, which involves buying stocks at a significant discount to their intrinsic value to reduce the risk of loss. He emphasizes that investors should always focus on the preservation of capital first and foremost, and only then consider the potential for gains. Graham highlights the importance of a disciplined and rational approach to investing and warns against emotional or irrational decision-making. He emphasizes the need to conduct thorough research and analysis and to avoid speculation or overconfidence. Furthermore, Graham emphasizes the importance of staying true to one's principles and values and avoiding the temptation to follow the crowd or chase short-term gains. He encourages investors to develop their own investment philosophy and stick to it, even in the face of uncertainty or adversity. That's it for our summary of The Intelligent Investor by Benjamin Graham. We hope you found this breakdown of every chapter helpful and informative. If you want to learn more about value investing and how to apply its principles to your own portfolio, we highly recommend you get your own copy of The Intelligent Investor by following the link in the description. And if you enjoyed this video, please give it a thumbs up and subscribe to our channel for more book summaries and insights. Thanks for watching.